A members voluntary liquidation is a formal winding up process for a company. It's used where a company is in a solvent position, whereby it's able to repay its debts in full within a period of 12 months. Ordinarily, it's appropriate for a company where there are in excess of £25,000 of distributable reserves in the company. The MVL process has a few different steps, ranging from pre-appointment, appointment and post-appointment. The pre-appointment stage is very much about getting the company ready to enter the MVL process. Getting a company ready to be in an MVL process is making sure that everything's tied up appropriately from an accounting perspective. This means using your accountant to deal with the final set of accounts, finalising tax returns like corporation tax, PAYE, VAT, and most importantly making sure that any liabilities that might be due as a result of those returns are actually paid. Paying these liabilities before entering the MVL process is important because it avoids HMRC adding statutory interest onto those debts once the company enters the MVL process. Once a company is ready to enter the MVL process, it's gathering the relevant information for the insolvency practitioner to be able to do so. That's usually general accounting information, HMRC reference numbers, copies of the last sets of accounts, details of where that tax position has been drawn up to, and again, importantly, confirmation that all liabilities have been repaid where possible. Once that information is gathered, the insolvency practitioner is then in a position to prepare the initial documentation to start the process. That appointment process can ordinarily all happen within the same day, providing that we're able to get consent to short notice from 90% of the company shareholders. That appointment process includes a board meeting of directors, which then convenes a meeting of the company shareholders. It's at that meeting of shareholders where the company enters liquidation. In between those two parts of the process, the directors of the company will sign a document called a Declaration of Solvency. That Declaration of Solvency is very much like a simplified balance sheet with a statutory declaration of truth on the front of it. Yourself as director, you're making a declaration that the contents of that document are truth to the best of your knowledge. That declaration has got to be made in front of a solicitor. Once a company has been placed into members voluntary liquidation, we're then in the post-appointment stage. That's the most important part of the process from a shareholding perspective because that's the time when distributions are made to shareholders in respect of the funds and assets that the company holds. Once all funds have been distributed and the insolvency practitioner is content that everything's been dealt with HMRC, and ideally HMRC have given some form of confirmation that that's the case can then be progressed on to closure. Ordinarily, an MVL process is appropriate for a company that is able to repay its debts in full and has in excess of £25,000 in the bank or in assets as distributable reserves. The key difference between MVL and other liquidations is an MVL is a solvent winding up process. So that means that the company is able to repay its debts in full as opposed to it's in a position where it's unable to pay its creditors. The other types of process like creditors voluntary liquidation and compulsory liquidation deal with an insolvent situation. Additionally, in an MVL process, there's no investigations in respect of the conduct of the directors, mainly because there is no detriment to creditors and it's the shareholders that are receiving the funds back as part of that process. One of the main benefits that are there for shareholders in choosing an MVL in respect of the winding up of their company is often the tax benefits that they receive from the process. This tax benefit is ordinarily known as business asset disposal relief. Historically, it had been known as entrepreneurs relief. This is a tax benefit that gives them a reduced rate of tax for that exit from the business. Up until the 6th of April 2026, that tax benefit is a tax rate of 14% on distributions from the MVL process, increasing on the 6th of April 2026 to 18%. It's currently unknown as to whether there will be any further increase with changes in future budgets, but the current lifetime cap on those distributions is set at £1 million. Ordinarily, a company that we'd be dealing with that goes through an MVL process has the same directors as it does shareholders, but a shareholder's involvement solely is to deal with the appointment of the liquidator. The meeting of shareholders is convened by the directors, and then at the meeting of shareholders, or members as it is also known, that is when the shareholders get involved and appoint who they wish to be the liquidator of the company, at the same time as passing the resolution to wind the company up. Of course, where we're dealing with a company that has the same directors and shareholders in those roles, then the shareholders are also involved at the director stage in dealing with the holding of the board meeting as well, and the signing of the Declaration of Solvency. But there is a clear distinction as to who signs that document, and it's first and foremost only the directors. The shareholders are there to deal with the appointment of the liquidators at the members' meeting. Typically, once a company has entered the MVL process, you should expect it to last anywhere between 3 and 6 months. However, it wouldn't be out of the ordinary for it to go beyond that time frame. The main reason this will be is because the insolvency practitioner has to be content that everything has been dealt with from a tax position with HMRC. If HMRC are writing and advising that there are outstanding tax returns, those matters must be dealt with before the MVL is progressed to closure. A lot of the time though in an MVL, the majority of the distributions have already been made to the shareholders by this point, and that prolonged period of the liquidation process whilst dealing with HMRC has little or no impact on the shareholders themselves. The tax implications for a shareholder in an MVL process can vary based upon the shareholder's individual circumstances. Ordinarily, a shareholder entering into an MVL process is wanting to take advantage of the tax relief available to them through business asset disposal relief. We would always advise any shareholder that is considering an MVL process that they do need to seek their own independent tax advice in that scenario. If we were to be acting as liquidator in respect of the MVL, we do become conflicted in providing further advice regarding an individual's tax position. The key purpose of an MVL process is to distribute the assets of the company out to its shareholders. In its simplest form, this will be the distribution of cash balances held in current accounts, savings accounts, etc., but it can extend to the distribution of physical assets. This is done through what's known as a distribution in specie. In some instances, the company's articles of association will provide for a distribution in specie to be made. If there's an absence of this within the articles of association, then at the members' meeting where the liquidator is appointed, a special resolution can also be passed to allow that distribution in specie to be made. Where a director has a company go through an MVL process, or shareholder for that fact, there is no impact on any other businesses that they're operating. This is a solvent winding up process. There is no negative stigma attached to the process itself. It's merely a form of winding the company down in an orderly manner in order to extract the funds in the most tax efficient way.